Good morning, friends. It's great to be back here moderating this panel once again. And what a diverse panel we have. From the US, Gene has flown in all the way there, to multiple cities in Asia, South Asia, Singapore, Hong Kong, and of course, Neha from Gurgaon, Mumbai. Okay, that's it. The diversity is fantastic. The strategies are so different, traditional private equity, secondaries, and of course, co-invest platforms. The type of LPs, international domestic institutions to traditional private equity. And of course, it's so fantastic to see gender being represented. I've seen it over the years, it's just grown. It's wonderful to see that. Thank you so much, Ankita and Neha, for the inspiring journeys that you are setting trends for others. As you can see, I try and emulate, but I don't even come close. On a more serious note, friends, post-COVID, you would have seen disruption replacing change as being the only constant in the proverb. More recent times, unpredictability is finding a seat at the table, and that's not making things simpler for any of us. And in these times, the eternal optimist in me always wants to bring out the positives. One, you know this better than anyone else. While there is discontent on sluggishness of growth, absolute growth without the relativity is not complete. And there, India still ranks at the top end. Second, something that you all have contributed to, the tectonic shift of domestic capital being invested in the country. A wise private equity investor once told me, we get tremendous confidence when we see domestic capital getting invested locally. And third, you may not know this, but in October and November, 4,700 CEOs from across 110 countries were surveyed. Over 1,200 of them represented companies with revenues over $1 billion. Now that's some real brain power. India continues to be in the top 5 as the survey. It's not gone down, not gone up, but there. 3 years ago, CEOs' optimism for economic growth was as low as 18%. A couple of years ago, it went up to 38. This year, it was at 57. But like always, Indian CEOs have been part of that. And guess what was the percentage of optimism for them? A whopping 87%. So these are the 3 positives I thought I'll highlight to you all before I get into this. I'm going to be having the right to ask questions. Normally in your conversations, they are the ones who are asking you the right questions. So while it's the easy job of asking the right questions, the more difficult one is of being able to ask the right ones, which they normally land up doing. And sitting is the new smoking, so I'm going to take the liberty of getting from the smoking to the non-smoking zone during the panel if it's fine with you. But let me kickstart this going right up to the title of the panel, Evaluating Risk and Reward, LP Perspectives. And if you'll notice, this is probably the only panel which are fantastic outside in view. So they'll be able to get a different perspective to all of us. Amit, why don't I start with you? Your sense on where investors see this country from a risk-reward perspective compared to other jurisdictions that you've been looking at.
Yeah, no thanks. Look, first of all, thanks everyone for that very, very warm welcome. I mean, this is the first time I've been sort of introduced like the way we did this. But going back to your question, Gautam, look, if I can summarize it in one word, it is attractive right now. I mean, India has been an attractive market, but attractive in a double quotes for many, many years, but this time it feels different. I mean, I've been in the industry for almost 20 years now, and it feels there is something different this time around. We all know, the macro story, GDP growth, dividend, demographic dividend, whatnot, but the last few years feels things have definitely moved in the right direction from a PE VC industry perspective. We see more and more buyouts. The overall volumes, while they may be stable, I think first half 24 was stable versus first half 23, but we see more buyouts, so the GPs are obviously influencing more control over the companies. Exits is a big improvement, right? I mean, first half 24 again, data shows was above 23 by almost 40%. IPO markets very robust. 60% of those exits were actually through the IPO markets. many managers compared to, let's say, 20 years back today have gone through cycles. They have gone and seen and actually tried various strategies, and some things have worked, some things have not worked. But we actually see very strong results from top quartile managers coming from India. So all in all, it feels that the environment is much better, and there is definitely a case to be made on the back of secular trends, FX being more stable, exit environment being more robust, buyouts becoming more prevalent, and the overall attractiveness of the PE/VC industry is definitely a lot more than where we were. So I would summarize it by saying it is definitely attractive right now.
Thank you, Amit. Someone from the industry, I think, had mentioned that the story of Incredible India is slowly but surely transforming into the reality of Credible India. And I think you're kind of resonating that, so thanks for that. Neha, I know you head up South Asia in IFC, right? What's your perspective, coming closer to the ground over here on this same question?
So I think India is definitely a compelling opportunity today. The one sort of question mark for India has always been, or maybe two question marks for India in terms of both private equity and VC, has been valuations and exits. If you look at valuations, they are high. Relative to all other geographies, all other emerging markets, they're definitely high. But having said that, people have still made money. And that is shown in the exits that we've seen over the last few years. So valuations are high, but there is also high growth. And therefore, there is a risk-adjusted return that we can see is generated in India. The second risk, but also a reward, has been exits. And Amit touched upon it. If you look at the last 5 or 6 years, about $130 billion of exits have happened in India. That's about 2/3 of the overall exits that have happened over the last decade and a half. So pretty much all the exits we've seen in this last 5-6 year period. The risk to that is also, most of these exits have also been to the listed markets, the IPOs, the QIPs, and exits for publicly listed companies. And a lot of private equity firms, which was something which was unheard of. If you looked at the decade before, very few exits were in IPOs. Most of the exits were private exits. Today it's turned. So the question remains, and that is one question that LPs keep asking: is this replicable? Is this sustainable? Are we going to see this continuing? But there are many positives, right? The macro is positive, structural drivers, the founder ecosystem. The GP ecosystem is much more robust today. As an LP, it's a great problem to have, that we have plenty of GPs to choose from, depending on which segment, which strategy we are targeting on. So definitely a good problem to have. A much stronger ecosystem, both at the private equity VC side, the GP side, and the founder side. There are risks, but nothing that we can't surmount. I think we just need to keep a sane head on our shoulders and continue to sort of be disciplined.
Thanks for sharing that perspective, Neha, and the data point, right, about the exits. I think that's where the rubber really hits the road of getting the capital back. So that's a bit on the broad risk and rewards. I mean, while it's good to have that view, Kunal, be good to also hear the here and now, with what's happening around the world, tariffs, interest rates, elections. Just what does it mean for India, or is there any recalibration required in the short to medium term on investment strategies or investments?
Yeah, I mean, I think, look, we might be preaching to the choir here. We all believe in the strengths of the India PE VC ecosystem, and we've come a long way just from the data we've all talked about on the amount of dollar capital that used to come into India on the PEV side has grown multifold in the last few years, and that's evident in the data. But I think, having said that, we've also entered a more different environment where the risks are elevated. Fair to say that perhaps last few years, India, the boat was sailing quite smoothly. I think we've entered an environment where we are entering choppy waters, whether it comes to the new US administration and the waves that creates globally for everybody. And I think that will be a lot of navigation that will be needed on behalf of by the government, and that will have impact on macro and things like the currency, for instance. You've seen some impact of that coming through. We've seen FIIs selling. I mean, first 40 days of the year, I mean, if the numbers I have is correct, about $10 billion of capital has left India. That's a large amount of capital to leave India in 40 days time at the start of the year as well. And the stock market has corrected and shown signs of that correction. So I think what that need is that while the playbook has worked in an environment that was more benign and congenial, I think you'll need to make tweaks to that playbook as we enter the current environment. For example, last year was very strong on exits and IPO markets were conducive. I think more and more we encourage managers to think through options on exit. So capital market is yes, one option. If you just look at the pipeline of IPOs that everybody wants to take to the market, I'll be very surprised if all of them went for IPO, right? So at the end of the day, you will have to find what are the option B and option C's, or run dual track exit processes, for example, to be able to make sure that, look, you're able to, yes, try and get the real value of the business, but it'll be almost impossible to exit everything for everybody, even in the current year, in the next 12, 18 months, and just hoping that the environment doesn't turn more negative.
Thanks for shortlisting that plan B and getting that square on the table. Gina, I'm going to come to you for a slightly different perspective. But Ankita, as part of Schroders Capital and in Singapore, what's your perspective on this here and now and the impact of these changes that are happening so rapidly right now across the world for India and the calibration, if any, needed?
Of course. Look, I think it's a very interesting question, right? And it's a little bit trickier to answer because our investment, we're very long-term investors, and my investment horizon today is anywhere in the next 4 to 12 years. So it becomes really important when we're kind of doing this investment to just kind of maintain the perspective and kind of try and envisage what is going to be a long-term impact of any of the changes that are kind of happening today. I mean, obviously on our portfolio and on our existing investments, you maintain a cautious strategy, but when it comes to new investments, it's really important to understand that the world may not look similar in the next 5 to 8 years, and it's important to identify what are the long-term trends that are really happening. And then from that perspective, I think we continue to, two things that we continue to maintain with respect to India is that I think local for local, of course, continues to be a very, very strong story with India because the Indian growth trajectory and the value unlocking that is happening in this country is continuing to remain unmarred irrespective of global geopolitical impacts. And I think the second thing that we really encourage our fund partners to focus on is continued long-term value unlocking. I think my panelists here have already spoken about the fact that there's a lot of exits that happen through IPO markets, and then there's a lot of question in global LPs who are looking at this interesting development that's happening where Indian retail investors are really driving growth. And there's a lot of question on how sustainable this is going to be. This is great. I think as investors, we're very happy about it. But we do focus on the continued premise of long-term investment, which will deliver value irrespective of what happens on the...
Thanks, Ankita. David, as an investment advisory firm, right, you must be seeing and interacting with quite a vast arena of folks, both on the LP and GP side. Your take either on the risk-reward piece or the here and now, right, from an India perspective?
Sure. Thanks, Gautam. So thank you for having me. Auburn Advisors is an international non-discretionary investment consultant in the alternative space. We do advise a very wide spread of clients from family offices, sovereign wealth funds, pensions, endowments, and foundations, insurance companies, for example. And this question that we have about risk-reward and the attractiveness of India has to be taken from a global context. And each group has very different ways of evaluating risk and evaluating the return expectations. I think India today, we need to recognize it as an interesting, attractive investment destination on the emerging market side, but we are also competing with the largest market, which is really the US, call it private equity market. which over the last 15 years has really consistently returned a very high, call it median, mid-teens returns. No dollar depreciation, very stable exits until the last couple of years have been fairly strong and consistent. Compared to India, which, I think when we comb and speak to a lot of our client base, it's quite a bifurcated group. Some of them have been in India for 10, 15 years investing in the space. Some of them are new to the space and first time. Each of their expectations and their experience has been quite mixed in the overall scheme of things. And we all agree that I think macro-wise there's no dispute and on the potential for India and also what has happened in India in the last 15 years development to this day. But I think two things need to really happen for India, right? One is not just us as an industry need to step up to consistently deliver the outperformance that are expected of us, but also that what do we think the US investors or US private equity is going to return going forward, right? The levers of return, the drivers of return that our investors are looking at are quite different. In the US, it's been much more of an LBO playbook, very consistent leverage. Multiple expansion has been very strong there as well because capital markets has been one of the strongest, very comparable to India in the last few years as well. But what are we expecting that to happen, right? And that's the question that we constantly test our investors and our clients because, when you have delivering kind of mid-teen returns for the last 15 years consistently, you then ask yourself, do I really want to go out there to rock the boat and try to find new things, right? When, 15 years I've been getting good things, everybody's telling me that it's expensive in the US and it's going to come down. It hasn't, right? In fact, really kind of corrected very significantly. So when we think about India, I think we need to think about who are we really targeting as international investors. And I think as an industry, we really need to think about what we as an industry need to step up to deliver the returns such as we can attract international capital. Last 5 years or so, I think we've been very successful in collaboration with the government and the community to attract international capital to come in, but more success has been actually driven by the domestic capital stepping up to fund a lot of the public markets, to the SIP program, with the financial institutions, the state also injecting a lot of capital into the space across private market strategies. But we also saw in certain sectors and so on and so forth, foreign capital actually flowing out. There's a lot of talk about, foreign capital flowing out through secondary trades on the public side, but, people also then forget about that, in the new IPOs, the foreign investors are coming in as well. So I think net flows have been, quite stable. But on the private side, I think, today the market has somewhat changed with the mixed returns that we've seen over the last, decade or so. I think people are starting to look at it, where's the biggest capital coming in? And if you look at the proxy in the marketplace today, it's the big boys, right? Your Barings, your EQTs, your Blackstones, they're going to raise, $10, $15 billion funds. The US pensions are, most of their capital is going to be allocated to that space. And they see it as an attractive market post, China plus one, the India emerging market story is very attractive. But what we need to also see is that, most of you represented here are from, domestic PE funds. We need to also look at how we can attract those international capital to come in beyond, people that have to invest in Asia. The international capital community have, you're almost at a place now where you can invest in anything you want, right? Even the hard to access funds, often there's a window for you to access them today. Why do I invest in India? And that's the question that, I think for us, we need to think about how do we deliver it, the GPs here as well, thinking about distributions and exits, not just, finding exits, but seeking good exits, right, to stump up the currency depreciation and the longer holding periods that we've been accustomed to in India.
Thanks, David, for sharing that perspective of India is good, but US consistent returns. And where do we find the space or the type of investors to attract them to invest beyond what is allocated, right, from a diversification perspective? Thanks for sharing that. Gene, I know you've been investing and looking at India since decades. I had a slightly different perspective that I'd love you to share. What do you think has changed or evolved over the past to now? We are sensing things on the ground, but from your perspective, what has changed or evolved?
Well, thankfully, for 57 stars, we're no longer left with blind pool, minority growth funds, which characterized, the early part of the millennium. today it's exciting for us. India's evolved tremendously. Domain specialization has been a real benefit for us as we do our portfolio construction. You can find specialists in almost every sector. We like to find domain specialists. We invest with venture funds, we invest with growth funds and control, but that specialization is important because we also like to co-invest. And we recognize we're not a direct investor. We try to deploy $1 to fund, $1 to co-investment, and so working with sector specialists has been a great benefit to us. I'd also say, to the comments that have already been made about the domestic money that's come into the market, that's been very, very helpful. Less dependency on international flows that, if you look at China, China has seen a tremendous amount of international capital run away. It's fully dependent on the RMB market. The same has happened in Brazil. I mean, if you really step back to the early part of the millennium, India is like the survivor today of the BRICS markets. China was, the 15-year run from 2004 to 2019, but I think right now the page is turned and it's India's opportunity. As we look at deploying money into funds, what's also changed is all of our options, not only with specialization, but the ways we can deploy our money. Today we can create separate accounts. We can optimize by looking at managers who might have a few legacy assets that we like and do a top-up fund. We can invest into continuation vehicles. There's always the secondary opportunity. All those opportunities of deploying the money in is enabling us to shrink the duration for which we hold and to get our money back more quickly. So from a portfolio construction standpoint, we want more of our money into co-investment that can have hold periods that can live up to a 5 to 6 year hold, maybe even earlier if possible. But then on the fund side, don't be left with just 10-year illiquid extending life funds. That's a category killer for us because we don't just deploy money, we need to raise money. And then what I'm really excited about also is on the liquidity solutions. We've heard a lot about the IPO market, but those same continuation vehicles have enabled us to have a few of our funds wind up and close down within the 10-year horizon over the last 2 years. We also see in the developed markets the evolution of things like NAV lending, which really hasn't come yet to India, but I think there are possibilities that it could. So in total, I think there's been a lot of evolution, really for the benefit of investors like ourselves, who can be opportunistic and really leverage our relationships with the better GPs.
Thanks so much, Gene. You mentioned continuum funds, and just remind the audience that SEBI has come out with regulations around continuum funds. IVCA did its bit on contributing to make it more workable. Rajat is part of the APAC committee, where I also happen to be there. So that's an option that is available. Shifting gears a bit, Kunal, AI and data, that's kind of replaced ESG as headlines. Any takeaways for this audience from the lens of AI and data? What should they be doing or thinking about?
I'm going to refrain from using too many buzzwords here. I think people get drowned in some of those over time. But I think, look, what's happening in the rest of the world and what we see as interesting trends emerge in other parts of the world is managers take a very proactive approach to leveraging this new evolution that we're all going through into their portfolios. So working with the management teams to ensure that they can maybe be more efficient in their own jobs, employ AI agents where they feel that can help with productivity and efficiency of their business, to help with things like customer service, with AI bots, and so many things. So look, the machine learning technology has been around for a long time. I think you are starting to see with DeepSeek and other sort of innovations coming through the market, the cost of accessing those technologies starting to come down. And so what we are starting to see is managers encourage their portfolios and work with their businesses, just like you had a value creation plan in the old days on M&A, on management hires, also having another leg to that management value creation plan by trying to leverage the data that your portfolio company is generating to create better insights, smarter insights, and create a more efficient business and how you run it.
Yeah, Neha, please go ahead.
I just wanted to add here, so technology is part of every business today, and it is affecting each and every business. So if there's a company which says, you know what, I'm an offline model, I'm a traditional model, this is not relevant to me, I think they're going to be in trouble very soon. So as GPs, I think GPs need to educate themselves and also try to educate their portfolio companies on what's happening in technology and how it could potentially disrupt their own business model. So I think it's critical, whether it's AI, ML, technology at the back end, front end, but it is critical today, absolutely critical.
It's technology-led businesses. Thank you, Neha, for that. Just since we are looking ahead, Ankita, I want to get a perspective from you. What's the kind of sectors or strategies or trends that you think will be interesting from an India GP's perspective as they look ahead, say 2 to 3 years? Because some of them may be in the process of fundraising or just seeing where to focus on.
Yeah. So, okay, let me take that question in 2 pieces, right? One is obviously we have strategies for GPs as well as transaction structures. That's very exciting. It's a very evolving space that I think Jean already mentioned, but I'll talk a little bit more about how we're thinking about it. And then the second piece is really around the sector side of things. I think from a GP perspective, focused, specialized GPs, whether it is on certain sector investments or it is on certain strategies, right? And when you say strategies, you're looking at GPs that particularly specialize in, like, say, for example, growth investments or turnarounds or platform creations, GPs that are focused on certain sectors. What we've seen is that they really bring a certain capability that differentiates themselves. Just talking also about where does India kind of find its niche, right? Why do we want to invest here? What do we bring in addition to the table? So for a GP to be able to stand out, if they can talk about something that they really have, years and decades of experience and they've seen the industry kind of evolve in a certain way, and if you kind of bring that GP in, that they've done this kind of transaction, they've done this kind of, worked on this sector for a long time, we see that there is real operational value creation that kind of happens over there. Also helps us to really, the fact that India is kind of growing really well, it presents itself as a very strong opportunity, but we can't really take away the fact that it's also a high risk. Macroeconomically, the risk associated with India is high. One of the ways to mitigate is to really kind of bring in specialization and capability into the mix. And then from a transaction structure perspective, I think it's like a really exciting time, right? Like you can absolutely do the straight fund-of-fund investments and then you kind of help your GPs, but we really want to partner with them in many more ways. And that really helps to create value. Like what we're looking at are a lot of win-win situations. It's not just India, right? Like overall private equity is really kind of coming of age. I think GP-led transactions, for example, is among the highest growing private equity investments that have happened in the last decade or so. And I think over the last 2 years, all of the major GPs in India have also explored at least the opportunities of, how can we think about continuation funds? How can we pick up our best assets and, continue to drive value, not only for ourselves, but also for our LPs. And that's a real focus. It's going to be a focus for us for the next 2-3 years. We really want to find alternate ways of partnering with them and leveraging our existing base to kind of drive more returns. I think coming on the sector side of things, it's very interesting, right? Like I think the last decade or so was very much about tech disruption, but tech is, like they mentioned, it's really become a part and parcel of every single business today. And so what we're starting to see is a lot more balanced approach. Again, kind of coming from a slightly risk-averse perspective, is that we're seeing a lot of new age companies, but also traditional brick and mortar companies starting to show a lot of revival, and they're continuing to grow, really develop with the unlocking of tier 2s and so on. So we're seeing a very balanced mix across all of the different sectors. There have been a lot of sectors that have grown really fast in the last 3 to 4 years, and we always kind of caution our GPs and say that, look, if if there's extremely fast growing that's happening, stop, take stock, see what's happening, because there is potential for disruption that continues to happen. That's the only thing I think on a sector perspective. Apart from that, I think most of the sectors are firing right now, which is great.
Thanks, Ankita. We are seeing, as you said, the more brick and mortar also investments happening in India may not be with too much of PE funding, whether it's infra or semiconductors or defense or EV batteries. Right? There's a lot of money going in gigafactories on the ground in India. On a slightly different note, I know we have a separate session on secondaries and co-invest later. But what's the action you're seeing? How relevant do you think it is for India at this point of time? Because I know you'll play in the space of co-invest and secondaries.
Yeah, look, I run the co-investments business for Alp Invest in Asia and very deeply involved with our secondary team as well. It's very important. I mean, there is definitely a case to be made from both LPs and GPs perspective to look into co-investments and secondaries. Obviously, from an LP perspective, no-brainer, right? It's a way to enhance your returns, mitigate the J-curve, develop relationships. But same applies to the GP, right? I mean, if you are able to work with your investors and not just look for primary capital, but actually work with them on transactions as a co-investment partner, you can showcase to them how you think about transactions. You can showcase to them how you manage companies, how you interact with management teams, how you handle certain difficult situations if and when they arrive. And there is a co-investor who is there with you. That just builds confidence a lot, right? That helps you to develop those trusts, those bonds. And those are, intangible but very positive or very important feedbacks that also play in the picture when it comes to fund re-ups. Because if experience as a co-investor has been positive, it will obviously channel into our primary diligence efforts when it comes to a fund re-up. So it becomes a sort of a circle. Like you obviously bring them as an investor, but if you can work with them on a co-investment, and same applies. I mean, on the secondary front also, it's important to get money back to your investors. And rather than just rely on, for example, IPO markets, they can be fickle, the windows can be open or shut down at a moment's notice. But if you can explore exit optionality using secondaries, whether it's continuation vehicles, whether it's NAV financing, Gene mentioned that. Obviously, it's a very well strategy that people have embraced in the Western world. It's coming and becoming more relevant in Asia. And the stigma that used to be associated with secondaries, let's say 10, 20 years back, is also gone. So I would definitely encourage GPs to explore not just looking at LPs for primary capital, but also looking at them as partners and basically working with them on co-investments or potential secondary opportunities where you can develop that relationship even further. And that just goes a long way.
I think that buzzer was not a media whisper, but a warning that we are getting close to end of 40 minutes with this. Time has flown. So I have a lot more questions, and I'm sure most in the audience have. But I think we go to India. I'll probably take a minute just to lighten the mood, do a quick rapid fire with you. This is not a coffee with Karan, but chai with our chahane walas. Ultimately, they're putting capital over here in the country. So very quickly, Neha, you've been part of the India GP family. One thing that Indian GPs should not do.
Don't under-communicate.
Don't under-communicate. Excellent. Amit, someone told me you're a big Bollywood song, right? So who's your favorite singer?
Well, I'm a big Arijit fan, and sometimes I do cooking on Sunday evenings. I'll play the songs, make pastas, and open a bottle of wine and all that. So,
hum a line. No, later. Gene, you are fond of waterfront habitats. A lot of us head to the US for work or vacation. One top spot you like to recommend?
I really like the Chesapeake Bay area with all of the tidal rivers. If you're in DC, you have the Potomac River. As you come down toward Virginia Beach, you have the Atlantic Ocean meeting with the Chesapeake Bay, and there are about 5 or 6 rivers. A ton of wildlife, waterfowl, fishing. It's a great opportunity. It's low key, so that's a good opportunity.
I'm heading there for my son's graduation, so make a note. Ankita, Singapore weekend, what do you indulge in?
It's a good one. There's a railway corridor. If anybody is going to Singapore, you should check it out. It's this old railway track that used to exist when Singapore was still a part of Malaysia, and then they've kind of really developed it. Most people don't go there, but I think it's something worth checking out.
Excellent. Yeah. Kunal, slightly different one. One wish list I know you're part of the LP Council of IVCA. One wish list that has not got off the to-do box or the not wish list box.
Well, there's a long list, but if you restrict it to one, I think, look, the LPs have been keen to engage, and I think this is the way we see it. This was a platform for them to voice their opinions and what they like to see. I think there's probably more that can be done in terms of a closer network or relationship between the LPs and GPs more informally. So rather than sit in front of them and pitch each time, I think that this is the way to build those relationships, and there are pain points on both sides. So I've been in that shoes before, so I can sometimes hear myself speak on the other side, so I get it. And I think these are the opportunities, and the council has provided these opportunities, IVCA has provided these opportunities to make those relationships and make them meaningful and not just a sort of a pitching session.
Thank you. David, what's the one thing that you love about India?
The people.
Friends, this panel is, I think between them, they would have traveled or moved 60,000 kilometers just to be here with us. We can at least move a couple of feet, stand up, and give them a good round of applause. Thank you so much.